This is ALBrooks, and this is my price action trading course. This module is about trading major trend reversal tops. Let me first begin with a higher high major trend reversal. First, you need proper context. You need a bull trend, and then next you need a break below the bull trend line. Preferably you want enough selling pressure to reach the moving average. Finally, you want a rally that goes up to the high, here a higher high, and then a reversal down. So the context is the bull trend, the trend line break, and then the rally to the high. And the signal, which completes the setup, is a bear reversal bar. As an example of a higher high major trend reversal, I'm going to use the daily chart of PBR, Petrobras. First of all, there's a bull trend, and in this case it's a bull channel, and then there's a break below the bull trend line, and the break had good selling pressure, a number of good sized bear bodies, and the break fell below the moving average. So the context is good so far. Next, there's a rally to a new high, maybe a double top, maybe slightly above the high, but look at the strength of the rally. We have a bull breakout and a total of 4 bull trend bars. The signal bar is either this bull bar or this 2-bar reversal. However, the tail is very big. Is it a short? Yes, but the probability is not very good because there's too much strength on this test of the bull high. You'd rather have the test be weaker than the original trend, and this test is as strong as certainly the most recent high. So to me, this is not a reliable sell signal, and it's better to wait for a second signal. The bulls see this as a double bottom, and a double bottom is a high 2 and a bull trend, and therefore they see this as a buy signal. They see this as a breakout of the high 2, and this as a probable pullback that will lead to higher prices. So the 4 bars up, these 4 bull bars with 2 of them being very large, I think that's too much buying pressure to begin to look for shorts. So it's a weak sell setup. If the bull resumes, make sure to get out. You can get out as soon as the bull trend resumes. In other words, as soon as the market goes above the high of the prior bar. You can put a stop around break even, or you can put a stop maybe above the high of your signal bar and take a small loss if the stop is hit. And this is what followed. We had a bear breakout, some follow through, another bear bar, but we're holding above the bull entry bar for the bulls who bought above the high 2 buy setup. And now we're starting to turn up. So if a person shorted below the low of this bear bar or below the low of this bull bar, we're back to around their entry price, and that's a reasonable location to exit a short, especially given that we're getting consecutive bull bars here. So I think the best thing to do, had you taken that short, is to get out with a small loss around break even. So that top failed, and we should begin the process over. We need a break below the bull trend line, we need the rally to resume, and then we need the market to turn down again around a prior high. The market accelerated to the upside. Too much buying pressure in this rally to short below this bear bar, even though it's a big bear reversal bar. The channel up is just too tight going up from here. So I would wait. We have 2 pushes down here and here. So that, in fact, is a high 2 buy setup above this bear bar. If you're looking for a top, I think it's probably better to not take the long and then reverse. I would instead wait to see if we get a sell signal before long. And we did. We have a very strong bear reversal bar. The high broke out above the top of the wedge, and we have a strong reversal bar down. So to me, this is a reasonable higher high major trend reversal setup. We broke the trend line, and we rallied to a higher high, and we're starting to get selling pressure, and the process is taking the shape of a wedge. Your initial stop is above the high of the signal bar. Your entry price is 1 tick below the low of the signal bar, Here the market looks like it gapped down below that low, so you would sell on the open. Remember, this is a daily chart. So we have a higher high major trend reversal, and within this higher high major trend reversal there's a smaller major trend reversal. You can look at this bull trend. We have a trend line break and then a rally to a new high. So there's a smaller pattern within the larger pattern. On the daily chart, I would not call this a major trend reversal. Maybe on a 60-minute chart it's a major trend reversal, but on a daily chart there are just not enough bars breaking the trend line, and the break did not go down to the moving average. On the daily chart, I would consider this to be a wedge top and higher high and a small final flag reversal. And this would be the small final flag. You could argue that this trading range is potentially a larger final flag, and it probably is on a higher time frame chart like a weekly chart. So you sold below the low of the signal bar, and we got a good entry bar, a big bear bar closing near its low, and we have good follow through. We have a bear bar on the next bar, and then we have another bear bar. We're down to the moving average, and we have a high 2 buy setup. It's still a bull trend. We're still making higher highs and lows. The market might be always in short based upon the context, the higher high major trend reversal, strong signal bar, and 4 consecutive bear bars. In my mind, I think it's always in short at this point, probably by the close of this bar. So that means I think that there'll be sellers above, and that we'll get a lower high rather than getting above the high of this bar. But the most you can be certain is 60%. At the moment, I think it's 60% certain that we'll get at least 2 legs down and at least 10 bars down. Because of the high 2, and because we're around twice the height of the signal bar, twice the size of the risk, this is a good location for taking partial profits or even full profits. Again, we're still in a higher low situation. We fell below this low, but this is not a major low. To me, this or this are more important lows. So I think we're still arguably in a bull trend, but after a wedge top, you should get 2 legs sideways to down. This might be the first leg down. To get a second leg, that means you need a pullback. So chances are this wedge will have a pullback, maybe to a lower high, and then a second leg down. So we should get a bounce here. You have to be ready to exit if the reversal fails. You can exit around break even, or if there appears to be a resumption of the bull trend, just get out at the market. The market is starting to trade up, and it had a lower high major trend reversal here, and it triggered. However, we started to curve up parabolically here, which is pretty good buying pressure. And now we have 2 small pushes down to the moving average, and the bulls will look at this as a high 2 buy setup. The bears still arguably are short with a stop above their signal bar. They might have their stop above their entry bar at this point, but I think it's probably better to, well, I don't know, I think you could argue either way. This is a pretty strong entry bar, so I think it's okay to have your stop just above it. If the market goes above it and reverses down, then you can short again. Again, we should get a second leg down, and we're channeling up. We're in a channel, and we've had 3 pushes, 1, 2, 3. So this might be a wedge lower high for a lower high major trend reversal. After higher high major trend reversals, you usually get at least 2 legs down, and you get a first leg and then a pullback to a lower high and then a second leg down, and that lower high is a lower high major trend reversal, and it's often a good location to add to a position or put on a position had you not taken the original position, or if you exited down around the moving average. So if you exit during this rally, you have to be ready to sell again, and if you're still short, you should consider selling more if we form a signal bar for a lower high major trend reversal short. Remember, you probably took partial profits around the moving average, so now you have a smaller position, and you can go back to a full position if we get another signal. Sometimes you'll have several attempts to put in a top before there's finally a major top with a big bear trend. So you have to be patient. Alright, we have a bear reversal bar in a wedge pattern, and it's a lower high. So this is a reasonable short below the low of that bar. Daily chart, it gapped down below the low of the bar. You can sell on the open of the bar as it gapped down below the signal bar, or you could wait to see if it has a bear close and then sell the close. So now we have a lower high major trend reversal after a higher high major trend reversal. And your stop at this point is above this second signal bar, the lower high major trend reversal signal bar. And this is what followed. A very strong bear spike, several big bars. This probably will result in at least a measured move down. So if you take this, the open of this series of big bear bars to the close of this bear bar and project down, it takes you down around here. A 60% chance that the market will get there, and in fact it did. 60% chance because it's a strong bear breakout. The market's always in short, and when you have a strong bear spike in a strong bear breakout, you have a 60% chance of the market reaching a measured move based on the height of the spike. So let's say you took the short, whether or not you took partial profits along the way. This would be a good location to take partial profits down here. We have a parabolic wedge, 3 pushes down, 1, 2, 3. So we have a spike and a channel, and the channel has 3 pushes. I don't have a trend channel line drawn in, but this bar would have broken below it and then reversed up. To me, this is not a strong enough bar to be looking to buy, even to buy to take profits on shorts. However, when we're starting to get more buying pressure, more bull bodies, and a strong bar like this, I think it's probably good to exit above the high of this bar. The market gapped up, I would get out on the open of this bear bar, and the bar sold off for the rest of the day. Down here, probably a good location for final profits, because now this might be a lower low major trend reversal. At this point we have a bear trend, right? I don't have the trend line drawn in. We have a break of the trend line, a test of the moving average, and now a lower low, and we have a 2-bar reversal with a bull body. So this is actually a buy signal for a lower low major trend reversal, a bottom. And since it's a buy signal, I would get out of shorts. I don't like to reverse, so I probably would not reverse. But if I was still short, I would get out of all my shorts at this point. Sometimes a spike and channel top can be followed by a major trend reversal. Remember, all channels evolve into trading ranges usually. So whenever you have a channel, you have to be ready for a possible reversal down. And then you often get a sell-off that goes all the way down to the bottom of the channel. Channels often have 3 pushes up. The spike is often the first push, and then you get a pullback, and you very often get 2 more pushes, so that you end up with a channel that has 3 pushes. Sometimes it has a wedge shape. You're looking for a breakout, a bull breakout above the top of the channel, and you want that breakout to fail, and for the market to form a bear signal bar for a reversal down. The trend down, the breakout, the reversal down, if it breaks below the bull trend line, which is the bottom of the channel, it may go down and test the moving average. If there's then a rally, preferably a weak rally, that could set up a test of the top of the bull trend. At that point, you have the context for a possible major trend reversal top. Next, you need the signal bar. You need the reversal down. Here's an example. We have a strong bull spike, probably will result in some kind of a measured move up. I don't have it marked in here, but it looks like the high is about a measured move up based on the height of the entire spike. And then after the spike, we have 3 pushes up. 1, 2, 3. You could argue that this is the first push, this is the second, and that's the third. It does not matter. In any case, there's an interesting phenomenon happening here. Look at the open of the day and then the low of the day. We had a bear trend, and the trend itself is not all that big. It's about 50 cents, about half of an average daily range in the spider. And then the market rallied strongly back up to the open of the day. If it breaks above the open of the day, it may go up for the same number of ticks that it fell below the open of the day, and if so, the market may come back and close back around the open of the day, setting up a doji bar on the daily chart. So there's resistance around a measured move up from the low of the day to the open of the day, and the market may sell off later in the day back down to the open of the day. So anyway, we have a bull channel, and we have 3 pushes up. You can draw this channel line across this high and then this high, in which case this would be a breakout above it, or you could simply draw it as a parallel of the bull trend line below, which is how I drew it here. And you can see the market poked a little bit above the line and then had a tail. And now we have a doji inside bar. So this is a possible top. As far as shorting below this this inside bar, it's still a bull trend. The market's still always in long. I think that's not a great short. And if you took that short, you'd be shorting a bull trend, and you would be doing it only for a scalp. The market sold off to the moving average. It broke below the bottom of the channel, so it's possible that if we get a test up of the high of the bull trend, we may get a major trend reversal. So the market's starting to bounce off the moving average, but look at the bounce. The bars are not that big. We have overlap. We already have a pullback. We have tails. So this rally so far is a lot weaker than this rally, and that's good. You want the rally that tests the bull high to be weak, and that increases the chances that it will fail and lead to a reversal down. You need a test of the bull high. After the resumption of the bull, which we're currently seeing, you look for a failure around the old high. The market may go to a higher high, may just double top, it may go to a lower high. It doesn't matter. You're looking for some kind of reversal down around the old high. And you also want the shape to be good. If the rally was 20 bars or more, the test of the bull high should be at least 5 to 10 bars. So if the bull trend was 20 bars or more, you want the test to be at least 5 or 10 bars. And you prefer it to be weak. You'd like it to be in two or more legs and not a strong bull spike. And you want to see some selling pressure. Small bull bodies, tails on the top, maybe an occasional bear bar, and maybe a pullback or two along the way. So here we are. We're trying to rally up. And so far we only have 4 bars in this lower high. And they're all bull bars. I would not short below this bar, even though you can argue it's a low 2. To me, we're still always in long, and I'd like to see more bars up and then a failure. This is not a convincing test of this high, and if the market comes down here, I think a lot of traders will be looking to buy this as a triangle. 1 push down, 2 pushes down, 3 pushes down. So if the setup is not quite right, you wait. You wait for a second signal, or you wait for a strong bear breakout. So you can see that some traders might argue this is a lower high major trend reversal, but it does not have enough bars, I think, in it to convince traders that this is the top. If you were trading a smaller time frame chart, like a 2-minute chart, it would have enough bars, and it probably would be a lower high major trend reversal on a 2-minute chart. But I'm trading the 5-minute chart here, and this is not a reliable sell setup. What about now? We have a micro double top, this bar and this bar, and now we have 7 bars in the pullback. So if the market falls below this bar, that would be a second signal short. I think that's a more reliable sell signal than selling below this bull bar. So that is one that I think is worth considering. Remember, most major trend reversals are low probability, usually 40 to 50% probability. And usually they don't initially trigger and always in reversal. So in other words, a top usually occurs when the market is still always in long, and it doesn't become always in short until after we get a bear breakout. To compensate for the low probability, you need to have a positive trader's equation. So if you have a low probability, you need a reward bigger than the risk. In general, you need a reward at least twice as big as the risk. So you determine your stop size and go for a profit target that's at least twice as big as your stop. So let's say you take the short below the low of this bar. Your stop probably is either above the high of the bar or above the high of the bear bar. And so now you know what your risk would be, and your reward has to be at least twice as big as your risk. So you would be looking to take profits, partial profits or full profits in this area. So the risk is 8 ticks, so you need at least 16 ticks of a reward to have a positive trader's equation when the probability is only 40 or 50%. Okay, will the market reverse to always in short if it triggers below that signal bar? Not necessarily. For it to reverse to always in short, you either need a big bear bar for your entry bar, if the context is supportive, and here the context is supportive. We have a potential lower high major trend reversal. You could also flip it to always in short if you have 2 or more consecutive strong bear bars, or if you have a strong break below the moving average. Any of these things can be enough for traders to look at the chart and say, yes, I think it's going further down. Yes, I think the market is now always in short. Again, since the probability might be as low as 40%, it might be 50%, but it's certainly not 60%. You need a reward at least 2 times greater than the risk. You can go ahead and place a buy limit order to take partial profits, maybe half off, at 2 times greater than the risk. So the target is twice as many ticks as in the protective stop. So you'd have a limit order to take partial profits here, and you would have been filled on this bar. Your initial risk is 8 ticks, 1 tick below the signal bar to 1 tick above the high of that bear bar, and that's 8 ticks. And so you'd want to take partial profits at 2 times that number, which is down here. So you'd have a limit order to take maybe half off here, and ultimately you're hoping that the market may come all the way back down to the bottom of the channel, as is often the case when you have a spike in channel. The channel usually evolves into a trading range. A trading range goes up and down. We've had the up part of the trading range, and now the bears are hoping that we get the down part, and they're hoping that it gets all the way to the bottom of the channel. At this point, if you look at this point and to the left, it's a bull trend. It's a spike and channel bull trend. However, now it's evolving into a trading range, and if we do come down here, traders will look at it as a trading range, and they'll see this bull channel as part of a trading range and not as part of a bull trend. However, it's both. It's the channel part of a spike and channel bull trend, and it's also the start of a trading range. Do you allow pullbacks? Sure. Trends have swings up and down. So that means if you're looking for a swing trade, you have to allow for some swings, some little bounces along the way. As long as the market keeps falling and forming lower highs and lower lows, the bear trend is still in effect. So if you're swing trading, you're looking for more than one leg down, and that means you have to allow a pullback. So you have a first leg down and then a pullback. You're looking for a second leg down, so there has to be a pullback, and then you get your second leg down. Sometimes the first pullback goes all the way above your entry price, so don't tighten your stop too soon. If it goes above your entry price and sells off again, then put your stop to break even, because you don't want the market to come back to your entry price a second time, because the bull trend will probably be resuming. You'd have a a high 2 buy signal and a double bottom, and that would be enough to erase whatever selling that has been in effect. Okay, when you're in a bear trend, you're channeling down, stair-stepping down. Every pullback that you get, sometimes they come from very strong buy signal bars. So sometimes it looks like the trend is resuming. But remember, you're in a bear trend at this point, and bear trends often have strong-looking buy setups. The context looks good, and you get a good signal bar. That's the setup. So it's always trying to trap weak bears out of their shorts, and it also will trap weak bulls in. But in a trend, 80% of reversal attempts fail and become bear flags. So don't exit too soon. Rely on your stop and rely on your profit targets. So don't be fooled and trapped out of a good trade. Rely on your protective stop and allow the pullbacks. As long as the market's continuing to form lower highs, keep trailing your stops above the most recent lower high and trust that the trend will keep stair-stepping down. So you might take partial profits here. In fact, you should. And now look what we have. We have two legs down, 1 and 2, so it's a two-legged pullback, and therefore it's a high 2 buy. Is it still a bull trend? Well, we're still making higher lows, and we have a higher high, so you could argue that it's still a bull trend, and therefore it's a high 2 and a bull trend. However, for me, this bear breakout is strong. We had confirmation on the follow-through bar, and then we had 2 more bear bars down, and now we're in a fairly tight bear channel. I personally would not buy that, and I think the odds are that we're in a bear trend and not still part of the bull trend. So for me, as strong as this 2-bar reversal appears to be, I think the odds are there'll be sellers above, and that will form a lower high and have more down. Also, we still have room down to support. So I would hold short with my stop above probably this bear bar or the top of this lower high. Again, the target is the bottom of the channel, right? We have a spike in a channel, and the market oftentimes comes back down to the bottom of the channel. Okay, this sell-off here is in such a tight channel that this bull reversal bar to me is not enough to erase the bearishness of this 4-bar bear spike. So probably sellers above, and we should get one more leg down. Okay, again, you often get a breakout test, and the rally often goes above the entry price, and it runs break-even stops of the weak bears who put their stops back to break-even too soon. The strong bears keep their stops above the most recent lower high, betting that the market will continue to make a series of lower highs and lower lows. In other words, that the market will continue to trend and that any reversal attempt will fail. So you can see this is testing the area of the entry price for the bears who shorted below this bar or below that bar. And I don't think it hit the break-even stop. But right now we're starting to form a potential lower high. We have 2 pushes up. We have a couple bull bars and then a bear bar and then another bull bar. So that's a small 2-legged rally. Some traders may have shorted on a stop below this neckline of a potential small head and shoulders top. We have the bear breakout. Those traders certainly would not put their stops to break even, and if they did, their stops would have been hit by this rally. Bears who are assuming that the market's in a bear trend, a bear channel, they're assuming that any rally attempt will fail. So what are they going to do? The aggressive ones will sell the closes of strong bear bars, strong bull bars, and then put a stop above the most recent higher low, betting that any rally attempt will fail and result in a lower high. More conservative traders, they'll look for setups like this. A pullback to the moving average, a low 1 or a low 2 short. They'll short either below this bull bar for the low 2 or they'll short below that bear bar. Traders who took profits over here, they may put a scalp on here and hold their swing trade. So they hold the swing trade until the market stops trending, and they keep taking scalps along the way in addition to their swing trade. Once the bear resumes, traders lower their protective stops. Either they just put them down to break even and allow bigger pullbacks, or they lower their stops to above the most recent lower high. Most traders will not let the market come back to their entry price a second time, right? They'll allow one test, but once the trend resumes again, they will not let the market come back and hit their entry price a second time. They'll get out at break even. All right, so the market tried to pull back here and reverse up, but instead we got a double top with this bar and that bar. And this bar, the high of this bar, as strong as the bar is, it stayed below this bar and it did not hit the break-even stops. So at this point, arguably, this is a decent swing short for a double top bear flag and a bear trend. So traders would place sell stops one tick below the low of this bull bar with protective stops one tick above. Probability, I think, is not all that high because we're near the bottom of a potential trading range. So traders probably should initially plan to go for a reward 2 times their risk. Once the move starts down, they can adjust their target based upon actual risk instead of initial risk. Again, remember I told you that the market might come down and test the open of the day, and that's what we're doing. So is this bear bar the start of a new bear trend, or is it simply a sell vacuum testing support of the open of the day and support of the bottom of the channel? At this point, we do not know. This is not good. If you're looking for a bear breakout, you want to see a second bear bar. Like here, you got a bear breakout and you got another bear bar. You don't want to see a bear breakout and then a bull bar, right? To me, that's not good for the bears. To me, I would consider taking profits right around the open, especially since we're getting some buying pressure at that support level. And I would also consider taking partial or full profits around the bottom of the channel. So I think it would be okay to take partial swing profits or full swing profits down here. As far as the bears who shorted as the market fell below the low of this bar, their actual risk probably was very small. We don't know how much this bar pulled back. It's possible it went below the bar and then traded all the way up to the top of the bar and then traded down again. So the actual risk might be above the high of this bear bar. I don't know. But if I had shorted below this bar and then I saw this bull bar, I would be pretty quick to take profits, either above its high or if we start to stall out here before it reaches the target. Okay, next I'm going to talk about a major trend reversal in the bond futures using a daily chart in a bull trend. Bond futures clearly in a very strong bull trend, and then we had a triangle late in the bull trend and then a very strong breakout. This could end up being an exhaustive buy climax and the top of the bull, and this triangle might end up being the final flag of the bull trend. We had a big move up, and now we have a pretty big move down. Big up, big down, big confusion. Usually the market goes sideways, and that's what it did. It went sideways enough to break below the bull trend line. I don't have the trend line drawn, but it's something like this. So we have a sell-off, and it broke below the bear trend line, and it also broke below the moving average. At this point, we don't know if the market is topping out or if it's forming a base for another leg up, right? Whenever you have a tight trading range, it becomes a 50-50 market. Equal chance of a resumption of the trend, equal chance of a reversal and a sell-off. So here is the trend line, and the market fell below the trend line, and it fell below the moving average, although it's continuing to find buyers at the moving average. See how the closes are all above the moving average? When we got a close below, it immediately reversed up. Close below, immediately reversed up. Tight trading range. So a tight trading range in a bull trend is often the final flag of the bull trend. So to me, at the moment, I would do nothing. But if we do get an upside breakout, I would start looking for a major trend reversal and for a turn down, first back into the tight trading range and then possibly below. At the moment, too much buying pressure. The market is having a hard time closing below the moving average. So if there's a weak major trend reversal signal, it's probably better to wait. If there are too many consecutive bull bars, for example, in the test of the old bull high, or if there's a weak signal bar, or if the rally is in the form of a bull micro channel, that's all too much buying pressure, and I would not take the short signal. I would wait for a second signal or a stronger signal. And look what we had. We had an II pattern, a breakout mode pattern, after a 2-bar reversal. We have a little bull breakout here, and we have follow through, so the market's going at least a little higher. But now we have a pause bar here, and then we have a bear bar here. Possible lower high major trend reversal, but a bull signal bar, which I don't like. So whenever the setup, the context is not perfect, and here it's not. We have too much buying pressure in this leg up. If the context is not perfect, I need a perfect signal bar. and to me this is not a perfect signal bar. We have 11 consecutive bars up in this bull microchannel, and that's just too much buying pressure. So I would need a very strong signal bar, and we don't have one. So I would not take that short. Instead, I would wait. And this is what happened. The market broke below the bull microchannel, triggering the lower high major trend reversal, but I would not take that short. With these two pushes down here, up and down, it's a high 2 bull flag. It's also a triangle, 3 pushes down, 1, 2, 3. Swing bull traders can take this for a leg up. I would be hesitant to do that because we have a tight trading range, and that's a very strong magnet, and I suspect that any rally we get in here is going to come back to this tight trading range before we go very high, much higher. So would I take this buy and then look to short since I expect the market's going to come back here? I would not. Whenever I think the market's going to go down and I have a possible buy in the meantime, I usually don't take the buy and instead just wait to see if I get my sell signal. Okay, here we have a second entry short. We had the reversal bar here, but a bull body, not good. We had reversal here, but a bull body, not good. Here we have a bear body and arguably a wedge higher high. We're above the prior high, and we have 3 pushes up. 1 push here, 2 pushes here, and 3 pushes there. Or you could say this is the first push, second push, and third push. In any case, it looks like this might function as a wedge higher high major trend reversal, and I think that's probably an okay short because we have a bear signal bar and we have a second entry. What's the probability? Doesn't matter. It's at least 40 or 50%, and the context is good. So we have good context and a decent signal bar, a bear body, and that is an okay short. Additional evidence: whenever you're looking to take a trade, always look for additional reasons. Like a wedge top, a measured move, a second signal, a bear signal bar. Well, we have a second signal and we have a bear signal bar. But is there also a measured move where we are? Is there also a wedge top? I mentioned that there might be a wedge top. Okay? In fact, you can draw a wedge pattern in here with these pink lines. And a tight trading range is a trading range, and trading ranges often lead to measured moves. So if you look at the bottom of the range to the top of the range and project up, that's exactly where the market's starting to fail. We poked a little bit above the measured move target. We poked a little bit above the trend channel line, and now we have a bear signal bar. So this increases the chances that this will be a successful wedge higher high major trend reversal at a resistance level, the top of a channel, and at a measured move target. If you take the trade, you sell 1 tick below the signal bar, and your initial stop is 1 tick above the signal bar. At this point, this is a daily chart. The bar is 31 ticks tall, so your initial risk is 33 ticks, 2 ticks more, because you entered 1 tick below, and your stop is 1 tick above. So look what followed 2 bars after the second bar after the entry. We have a very big bear bar, but there's something special about this bear bar. It's a breakout bar, obviously. Its close is below the low of the moving average. Its close is below the low of the prior bar. So there's a big gap between the close and the low of the prior bar. But the close is also below this low and below all of these bars as well. So this bear bar is reversing the lows of the past 10 bars or so and the closes of the past 10 bars or so. So all the traders who bought in here are now holding losing positions. So this is a very important sell signal bar, and chances are the traders who bought in here will look for any rally to exit, so there should be sellers on any pullback. And this is what happened. We had the big bear breakout bar, but followed by a bull inside bar. Not good for the bears. You always prefer a series of strong bear bars. You don't want a strong bear breakout bar followed by a bull bar. The bulls will argue that this is just a high 2 legs down, 1, 2. So a double bottom, 1, 2, and a buy signal. To me, I think it's still on the higher high major trend reversal sell. You could lower your stop to just above the high of the bear bar if you wanted, but I think technically it's probably better to keep it above the high of the signal bar until after the trend resumes down. So the failed bear breakout resulted in a doji bar, not good for the bulls, and then another bear bar, and then we have a second push up. So technically this is a low too short below the low of that big outside up bar, but 5 sideways bars, I would not take that short. However, I would hold short and probably lower my stop to just above the high of this lower high. Okay, so what do you do down here? We're back down to the low of the tight trading range, and now we have a reversal bar, a doji body, not strong, but this is pretty much 3 little pushes down. We went down here and then up on this bull bar, and then down again, and then sideways, and down again. So there's a small wedge bottom here, a large high 2 buy, one leg down here on this big bear bar, another leg down, and we're at the bottom of a trading range. So from right around this area to over here, we're in a trading range, and now we're at the bottom. We did not get sustained selling after the bear breakout, so rather than this turning into a strong bear trend, it appears that it's transitioning into a trading range. So to me, since this is arguably a buy signal, double bottom at the bottom of a trading range, I would at least exit part and maybe all of my short. And if I'm wrong and the trend resumes down, I look to short again. I personally would not reverse. An aggressive bull could buy here, a test of the bottom of a developing trading range. I personally probably would wait for a second signal before buying. If you only exited part of your position and you're continuing to swing, your stop is below the most recent lower high. So your swing stop at this point is right here. Final profits. Anytime you see a strong buy signal, you take final profits on your shorts. What's a strong buy signal? Maybe a measured move down to a wedge bottom, maybe a micro double bottom. If the location is good, bottom of a trading range. And look what we got here. We had one more push down, and now a bigger wedge. But here we have an inside bar, a bull inside bar. The market broke to the downside, but instead of continuing down, we reversed slightly. And now we have 3 bars with tails on the bottom. So we're trying to break out of the bottom of the wedge, and instead, every time we try, we reverse up with a tail. So to me, I would get out of any shorts above the high of this bar. Too much risk of a pullback, maybe to the top of the channel. We have a spike down, a pullback, and a bear channel with 3 pushes down. 1, 2, 3. So we may have a rally back up to the top of the channel. So if I took shorts, I personally would get out. Too much risk that the channel down will transition into a trading range. And I want to sell. I want to buy low and sell high, and since I'm short, I'm looking to buy, so I want to buy back here. I don't want to buy back way up here. Okay, I'm going to go through the same slides, slide by slide, with no marks on the chart, and I'm not going to say anything, just so that you can look at the chart bar by bar. And that is the end of the module on trading major trend reversal tops.